what I want to talk about today is why risk avoidance, risk management is so very important. It's really the biggest secret in investing. Napoleon had a saying that's widely quoted that said, any man can be a genius if he can do the average thing while all around him are going crazy. And it's sort of the same thing in investing. If we can keep our heads on straight in these times of stress, we're going to do very well. Doing well doesn't require exceptional insights or complex strategies. It just requires maintaining a level head and not shooting yourself in the foot when the markets are going wild like this. Billionaire investor Howard Marks used to tell a story about someone he was associated with who never really hit the ball out of the park. This was a professional investor whose averages were always in the mid quarter of the range, between the 27th percentile and the 47th percentile. He was never in the top quarter of the class. He was never in the bottom half. But he did this for 14 years in a row when Marx was telling the story. And you know where his returns ended up after 14 years? He was in the top 4% of all investors. So you don't have to hit it out of the park. All you have to do is have consistently above average returns to do very, very well. Normally, if you're between the 27th and the 47th percentile, you think you're going to average 37. But due to the math of gains and losses, it really works different. Now, I've talked about this before, but the math of gains and losses say if you drop 33% in account values, it's going to take you 50% gain to get back to even. If you drop 50%, it's going to take you 100% gain to get back to even. And this is not voodoo economics. This is just a matter of a changing base is what we call it. You start out with $1. That's the base that you've got in your account. If you lose 50% or 50 cents, you've only got 50 cents left. And if you want to get back to $1, your new base is now 50 cents. You don't have $1 to work with. You've only got 50 cents. So you have to literally earn 50 cents on 50 cents or double your money to get back. Now, the difference between losing 33%, losing 50%, both are uncomfortable. Both are really painful. But there's a huge difference in what you have to do to get back to even if you can reduce your losses just a little bit over the average market. And that's what we try and do here at Shadowridge. You know, we're not perfect. We don't have crystal balls. We react to what is and reduce the risk in any one moment. And if we can just do that a little bit over time, we can be very successful like we have been. So far this year, we've had some losses. But if we can keep our losses smaller than the market over the long run, when the market turns around, we're going to have a lot more money to work with than somebody who held an index investment. I want to show you this because we advise our clients to gauge our success or our effectiveness over a full market cycle. And this is a 10-year chart showing the S&P 500 index through two big market cycles. The market was going up into early 2000. There's a down cycle, an up cycle, another down cycle, an up cycle. Together, it's really two full market cycles. So what I did is a few years ago to gauge the importance of risk management is I did a study, and there were 994 mutual funds that had been in existence since 1999. And these are just stock funds, funds that have more than 60% of their money invested in stocks. We included both no-load funds and commissioned funds, so we got a good gauge of the overall market. And all we did is we removed funds that lost more than 3/4 of the index losses. Now, in the 2000 to 2003 decline, the stock market declined 52%. In 2008, the stock market declined 56%. And if you had 3/4 of that or worse, you were out of the study. We just kept the funds that demonstrated effective risk management. That's what we're looking for. This is what we end up with. Here's the red line. This is the S&P 500, same chart as I showed you a minute ago for 10 years. And this is the funds. There were about 75, about 125 funds that made this screen. dramatically outperformed the S&P 500. But look at the reduction in risk back here in 2000, 2003. This was a 13% decline. That would have been real uncomfortable if you were invested at that point, but it's a lot better than a 52% decline. This decline was about 25%, a lot better than losing 56%. So this is the importance of successful risk management, just doing a little bit better over a long period of time, and you can come out really, really well. Many investors, the natural question to ask is, how much can I earn? And that's really not the best question. The best question to ask is, what's the most effective rate of return over a long period of time that's going to get me to where I want to be? If we can keep our heads straight in a market like this, we're going to do very, very well for you. And that's what we're trying to do. As Ryan mentioned, we're largely out of the market. Ryan had some short positions. He closed out a couple of days ago. I closed mine out this morning. The market seems to be bouncing today. We're just going to try and take that little bit of space we've got over the index performance and hold on to that for you right now.